I'm Charlotte McLeod with the Investing News Network, and here today with me is Adrian Day, President of Adrian Day Asset Management. Thank you so much for being here online with me today.
Well, thank you, Charlotte, for inviting me. Always good to see you.
Yes, it's great to see you as well. And we're catching up after almost a year. I think the last time that we spoke was way back in May of 2020. And obviously, a lot has happened in the gold space since then. When we were speaking at that time, you told me you wouldn't be surprised to see a new all-time high for gold in 2020, which did happen. So I want to ask you about what happened after that all-time high. Was it what you expected? And yeah, let's talk about how that played out for you.
Yeah, a few things, a few thoughts I have, because obviously this is something I've thought about a lot. I get a lot of questions, what's happening to gold? Why is it not moving higher and so on? A couple of things. First of all, I think it's important to say, in my view, people always expect too much from gold. Gold is not Bitcoin or Tesla or anything else. Gold is meant to be an asset that preserves purchasing power. So when you see gold from, I'm looking at the chart as I look away from you, from end of March to the beginning of August, when you see gold shoot up in US dollars over 40% in less than 4 months, that is an extraordinary and very unusual move for an asset like gold. So naturally, you get a pullback from that. What we saw from the August high to the low was basically a 50% pullback. To the low, it was about 56 or 57. That is a normal kind of retracement after a strong up move. You see it in all markets at all times. If you're waiting to buy a stock but you think has moved up too much, you look for a 40 to 60% retracement before buying. That's what we saw in gold. Frankly, the fact that it took so long for gold to get to that point, I think is a sign of underlying strength rather than the opposite. So obviously, after that huge run, you had the short-term speculators get out, and then you had the generalists get out. The generalists are pretty much out of gold. They got out pretty quickly. And then it was left to the more hardcore who were not negative, but were cautious. And so you had very little buying, very little new buying, and of course there's always selling. So it just drifted downwards. So I'm not, there were fundamental factors as well, of course. This year in particular, we had long-term interest rates in the US go up. That's negative for gold, other things being equal. We had the dollar hit its low almost on December the 31st and moved back up, other things being equal. Higher dollar is bad for gold. So we had those fundamental factors as well. But frankly, I'm not overly concerned about that long retracement.
Right. So you mentioned a couple of factors that may be influencing gold's price moves recently. Last year, it seemed like the conversation was so centered on money printing all around the world due to COVID-19. It seems like that's faded a little bit from conversations, although it continues to go on. So the question, I guess, is what factors do you think are most important for gold at the moment?
Yeah, it's a good question. Look, number one, central factor for gold is money printing, excess liquidity. If the central banks of the world create excess liquidity, which by definition is liquidity in excess of the current needs of the economy, clearly we've had that over the last year, not just in the US, but pretty much everywhere. When you have excess liquidity, that is the central factor for gold. And if you look back over 20, 30 years, the correlation between global liquidity and gold is very, very powerful and very strong indeed, about 70% correlation. Interest rates and the dollar are results of that. They're symptoms of that, but they're the thing we look at, but underlying all of that is global liquidity. So as you said, we've had ongoing global liquidity. After that initial spurt, after March of last year with the COVID and the lockdowns and so on, after that initial spurt of liquidity, a lot of banks, the US was one, started to moderate's the wrong word. There was nothing moderate about what the central banks were doing, but they started to moderate from that initial push, and you had a bit of a plateau, might be a better word. You had a plateau in the amount of money being printed. Starting around October, that absolutely reversed again. And now you've had money printing shoot back up almost everywhere, not in Canada, I've noticed, but in other countries. And in the US in particular, you had money go back to over, what, $7.8 trillion of Federal Reserve balance sheet now, from less than 7 last February. I'm sorry, from, what am I talking about? From less than 4 last February. And you've also had, let's say very powerful spending moves from the current administration. So after the 900 billion COVID relief that was distributed in January, you then had the new administration propose 2.3 trillion, which is already being distributed. Most people already have it. And before people already had that, they announced a budget for this year of another 2.3 trillion. And before that's even been approved by Congress, there was 2.5 of infrastructure spending. And before that measure's even been fully padded out, they're talking about 1 to 2 trillion to fight racial inequality. And on top of that, we're talking about another 1 to 2 trillion of additional COVID relief lasting probably till September. So there's a bit of leeway there, but that's between 8 and $10.5 trillion that's either been already distributed or proposed or planned in 3 months, basically. That is, again, totally unprecedented. And some of that's going to be paid for by higher taxes. Good luck with that. But there's absolutely no indication, certainly in the US, certainly in Europe, there's no indication that the central bank will not accommodate that excess spending. So, you know, I think that's one of the reasons that gold has turned around in the last month, because of all this new spending. And also, of course, this month, the dollar's gone down again and interest rates have moved down again. And those are consequences of the increase, of the new increase in the money supply that we've seen in the last couple of months.
And I think connected to all of this, one of the themes that I keep hearing come up is inflation. So to you, how does that fit into the picture here?
Yeah, two major thoughts on that. One is, I definitely, I think we're seeing inflation. It's not, I think we're going to see inflation. We are seeing inflation already, certainly in the US. You've had very strong input price increases, all the commodities, particularly things like wood and steel have gone up, but also the other commodities, agricultural produce has gone up. And so major companies like General Mills, which makes a lot of sugary cereals, hope I can't get sued for saying that, and Kimberly-Clark, you know, everybody knows Kimberly-Clark, both of those companies, among many, many others, have said that their input prices are rising across the board, and they will be raising prices at the consumer level very soon. And I'm seeing it in a lot of anecdotal things. So now something like 75% of Americans asked say they have noticed higher prices at the stores this year, which is quite an increase over what we saw before. And frankly, when it comes to inflation, anecdotal evidence is a lot more powerful than the government figures, particularly the index that the Federal Reserve likes to use, which downplays things like health and housing, which are going up a lot, but it downplays those things. So yeah, we're already seeing inflation. That's number one. The second major point I'd make, though, and there's reasons for that. I've got 3 points. The second point, though, is I was not one of those people who, after 2009, when we had all the money, all the QE, 1, 2, 3, 4, I was not one of those people who said that would lead to inflation. And the reason was because at that time, the Federal Reserve here, as well as the Bank of England, as well as the Bank of Japan, as well as the European Central Bank, the Federal Reserve was distributing that money directly to the money center banks. And by carrot and stick, they were encouraging them not to lend the money, right? One of the things they did was in 2009, they introduced the payment of interest on excess reserves. So the Federal Reserve was creating money, channeling it to the money center banks, but then saying, if you give it back to us, we'll pay you money on that so you can make a risk-free return. So of course the banks weren't lending it into the real economy. With basically helicopter money, direct distribution directly to households and directly to small businesses, but we've seen in the last year in this new program, that's completely changed. So money is getting into the real economy. Of course, during COVID, a lot of that money didn't go on restaurants and trips and other things. So the consumer price impact of that directly distributed money was very muted at first. And people started paying down credit card debt because they were sitting at home and had nowhere to go. Normally, when you give, when the government distributes money, you saw it with the Obama tax refund, 10 years ago now, when, a lot of taxpayers in the US got like $400 check. Well, 85% of that was spent immediately. It wasn't saved, it didn't cut down debt or anything. It was just spent immediately. Well, that didn't happen last year because of the lockdown. Sorry, so I'm rambling. Once the economy starts opening up, you're going to see that money go into consumer goods, which is going to increase the supply of consumer products. So yeah, we're getting inflation, no question.
Right. And putting all of this together for gold, what price activity are you expecting in 2021? It sounds like we're in a bit of a low point, but you're not too concerned about that in the long term.
Yeah. Well, you know what they say about predictions. You either predict a price or a time, but don't predict both of them. And you've already asked me 2021, so I'll just say higher. My sense is that for the next, several months, the next few months, the next several months, you could see gold move steadily higher, but not so meaningful that gold bugs are happy. So, over the next few months, we might get to that 1850 level where there's a fair degree of resistance at that level, but it will be up and down. I mean, I think we're going to get a retest of that 1750, which was for the last 3 months was the ceiling of a trading range. I think it's now become the floor, but we're going to test it again. We see a recovery in the dollar for any reason. Something happens in Europe, the euro goes down, the dollar goes up. Again, that's going to affect gold. After you've had such a long decline, and by long, I'm talking about from the beginning of August. So, you've had a 9-month decline in gold. Again, I'm very sanguine on that. And people forget gold is still up over $250 from the beginning of last year. That's nothing to shake a stick at, as they say. But we always expect more from gold, right? After you've had a long decline from that, you always have people sitting there saying, I wish I'd sold at 1900. Next time it gets there, I'm going to sell. So you have that sort of wall of selling pressure all the way up as you move up. So I think initially it's going to be, fairly subdued. But sometime towards the end of the year, maybe the fall, maybe the end of this year, beginning of next year, I think we're going to break to new all-time highs again. I think it's I won't say inevitable, nothing's inevitable, but well, death and taxes, I guess. But you've had such, as of last week, you had incredibly bearish sentiment on gold. And the scenario for gold, the outlook for gold, the environment is so positive. Yeah, I think we're going to see new highs, certainly within a year. Let's put it that way.
All right. So I think we have a pretty good idea now of what gold's been doing over the last year or so, where it could go in the future. Where are the gold stocks in all of this? Where are we seeing good performances and where might there be potential?
You know, this is what's so astonishing to me, Charlotte. You look at where we are with gold today. Forget the fact that it's down, $250 from the all-time high. But look at where gold is today, just under $1,800 compared with a year ago, 2 years ago, 3 years ago, 4 years ago. An extremely good price. Look at where the oil price is and other input costs for miners. Again, notwithstanding the recent rallies in the commodity currencies and the price of oil, we're still at very low prices. And yet the gold stocks are so depressed. You look at the Huey index, the New York Gold Stock Index, or the XAU index, gold and silver index. And in terms of, so these are all producers, in terms of price to book value, we're at under 50% of the historic valuation level. You look at price to cash flow, we're in the lowest 10 percentile, the lowest 10 percentile. That given the price of gold, given the environment for gold, given the outlook for gold, that simply does not make sense. So I think investors today forget about the rallies in gold stocks since February, into February, March, April. Forget about that. Investors today, in my mind, have a compelling opportunity when the outlook is so good and at the same time the prices are so low. I mean, the Huey, for example, would have to more than double to get back to where it was in 2011. The last time gold was at 1900. And yet the gold companies today, by and large, are much better companies, much better discipline than they were back then, much lower cost of input, higher margins on their production, et cetera, et cetera, et cetera. It simply doesn't make sense that the gold stocks are so low. Normally when prices move up, the stocks move too far, too fast, and you think you've missed it. All I can say is this is just the beginning, in my view. And I would stick with this, not stick, because we invest across the spectrum. But there's a saying that some people have: when the filet's on sale, don't bother with the hamburger. And when you can buy great companies like Agnico or Barrick, just to name two, when you can buy great major mining companies like that at bargain basement valuations, maybe you don't have to look too much further down the food chain.
So you mentioned it doesn't make sense why the gold stocks are still not performing as well as you might expect them to. Do you have any idea what's going on there? Why do we see that disconnect?
Yeah, I think a lot of it is, or some of it rather, is the fact that, generalists have exited the space. So you had, if you go back 15, 20 years or even more than that, before even the bull market in gold of the 2000s, every time you looked at a gold mutual fund, for example, one of its top 10 or top 20 holdings would be gold. It might be physical gold, it might be, Newmont or Barrick or something. They all owned some gold. They got out of it. They were badly hurt in 2011-12. Most managers of global funds are not used to a sector going down 83% as the gold stocks did. The XAU I'm talking about was the major companies. And so 10 years ago, or let's say 8 years ago, 7 years ago, I think it's fair to say that hardly any generalists at all had any gold. They were out of the space. Gingerly, cautiously, they came back in this year with all the money printing as gold was moving up, and then blow me down if they didn't start losing money again. So I think the generalists have got fed up and have exited. And that's one of the reasons that the gold stocks are so weak, because, let's face it, gold stocks is a small space. The entire gold stock market is what, a fifth, a sixth of the market cap of Microsoft, a seventh or eighth the size of Apple. We're talking about a small space. But notwithstanding that, there's only so many gold bugs. I mean, you need, generalist investors to come in. So if you look at most institutional investors today, they have less than 0.5% of their portfolios in gold, as opposed to a historic average of, 2 to 3%. So as gold moves up, they'll come back in again, obviously, because, that's what people do. And they get pressure to. Directors say, I looked at your portfolio, gold's up $400 and you don't have any gold stocks. What's the problem? So slowly the generalists will come back in, and they only need to go to 1% to have a dramatic impact on the gold stocks.
All right. So we've talked about price, we've talked a little bit about the companies, and there's really a lot of focus on the gold price, I think, in many of the conversations going on today. But what other trends are you seeing in gold that you think investors should be aware of for, let's say, this year?
For this year, well, two trends for gold stocks, and they're connected. As we all know, we as an industry globally are not we're not discovering as many ounces as we're producing. And in fact, if you look where we are currently, you look at the lowest global production of the last 5 years, and look at the highest discovery rate of the last 5 years. So I'm being very conservative in my numbers here. You see, we're discovering less than half the number of ounces that we're producing. Not just this year or last year because of COVID or anything, but consistently over the last several years. Clearly, that can't go on forever. No company wants to announce as a mission statement that they're going to shrink. They'll say we're going to focus on, profitable ounces. Growth for growth's sake is gone, it's out the window, all that stuff. That's all good. But nobody is going to say, over the next 5 years, we want to shrink the company by about 60%. So they will get those ounces. And if they can't find them, they're going to buy them. So the second trend, the obvious one, is M&A. I think we're going to have a big increase in M&A over the next year or two. We haven't seen as much in the last 12 months as people were expecting. Two main reasons. One is, remember 2011-12, when companies went on a spending spree, overpaying for marginal assets. And within 3 years, 75% of the money spent on gold acquisitions was written off. Not written down, written off. And as a consequence of that, there's a huge turnover in CEOs at the top, who were fired for wasting shareholder money. And so you've got this new mantra that I mentioned earlier, profitable ounces. That's what we're concerned with. So I think this newfound discipline is making CEOs a little bit cautious of what we might call dramatic, imaginative acquisitions. In addition to that, of course, over the last year, with all the restrictions, it was travel restrictions. It was very difficult to send your own team on site in many places, Argentina, Australia, Canada even. Very difficult to send your team to actually do the due diligence. I know from speaking to a lot of company CEOs, and including royalty companies, the same thing holds for royalty companies making big royalties acquisitions or deals. There's a lot of things in the pipeline, not at the LOI stage, but certainly more than just ideas. And I think we're going to see a lot of that come to fruition in the next year.
So we know that the larger gold miners are going to be having to make acquisitions. Would you expect M&A at the smaller levels of companies to some extent as well?
Yeah, I think we're going to see it across the board, but notwithstanding what I just said, we'll have a
Mm,
little bit of caution. Some of the big companies, like Barrick, for example, Mark Bristow, they talk about merger of equals, no premium mergers. Well, there's only so many of those can do. It has to actually make sense for the target company, because they can talk about mergers, but it's really one company taking over another. There's got to be a pretty compelling reason why a target company sells itself with no premium. If I can risk you getting sued, it might be Goldcorp that has run the company into the ground and management wants to collect their huge change of control bonuses. So yeah, let's go ahead and just sell this company at a 20-year low price. It might be Randgold, who sees relatively limited opportunities in Africa. They want to get bigger. They've done an incredible job. And now Mark Bristow, CEO of Randgold, has the opportunity to run a much larger company with great assets, but again, hasn't exactly done a very good job over the last 10 years until he turned up. But there's few of those companies that want to sell themselves for no premium. Most companies want a premium. So I think you're going to see more acquisitions at like the Equinox Premier kind of level. There's the intermediate kind of companies, where growing companies, want to get an additional project or more. At the junior level, the problem is, we own a lot of exploration companies, as you know. I mean, a lot of those people are doing incredible work, hardworking, and that's where discoveries come from, right? Ultimately. But the truth is, good projects are few and far between. So again, I've talked to a lot of people who say they've talked to, 5, 10, 15, 20. They've done due diligence, they've gone on site, and there just aren't projects that measure up to, what they're looking for. So I think we're going to see those acquisitions, but I think that'll come a little bit later.
interesting. Well, we've covered a lot of the gold market, and to wrap up, I want to take a brief step away from gold and ask you if there are any other commodities or areas of interest that you have right now.
Yeah, um, definitely. I mean, I'm interested in the whole commodity space, but I think a lot of them have moved a bit too far, too fast. I make a clear, we can talk about the demand for most commodities going up as the economy recovers. Some of them have the additional element of EV demand,
Mhm.
which is a big boost to the demand in the next few years. But I'm focused equally or as much on companies where there are supply constraints. So if you look at commodities where there's supply constraints, if you look at copper, for example, if you look at copper, we pretty much know the maximum copper that can be produced globally in 5 years' time. And the reason I say that is because if a major or semi-major or intermediate copper project got to go ahead today, it would be 5 years at least before it started producing. So we know what the potential for the copper production in 5 years is. Given the global recovery, given infrastructure, and given EV demand, there simply is not enough copper. There simply will not be enough copper in 3 to 5 years' time at today's price. So the price has to go up. There are other commodities, and I might get some flack from this, like oil, like uranium. I know some people aren't going to like that, but where there isn't an immediate shortage, so a potential shortage rather. So you look at oil. Saudi Arabia has vast excess capacity. If Saudi Arabia wanted to boost its production by 20 or 30% over the coming 6 months, they could do it. The oil's there. There's a lot of fields in Canada and the US that have been shut in. Notwithstanding environmental issues, that oil could come back on at the right price fairly quickly. Then the same goes with uranium. Kazakhstan, as you know, the largest exporting country, reduced production at all their mines about a year ago now, a little less than a year ago now. Again, that could be reversed pretty quickly at the right price and bring supply back on. That's not true of something like copper, for example. So I much favor commodities where there is that potential shortage of demand, of supply, in addition to increased demand.
Okay, well, I think that that's also really interesting, and I think that's a good place for us to wrap it up. Thank you so much for being here today to talk mostly about gold and also about some of the other commodities.
Well, thank you very much for having me. Always good, always good.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Adrian Day with Adrian Day Asset Management.